Hello, everyone. How you doing, Chris?
Good afternoon. Thank you for having me and hosting.
Hi, my name is Juan Grimaldo, agent with Keller Williams and the Grimaldo Group. We have our partner, Chris Verdon. And today we want to talk about conventional versus FHA loans. And Chris is an expert on this. He looks very young. I give him crap all the time about it because he looks very young.
I've got a
He is very
beard.
young. He's very wise. He's been growing that beard for a while to show that he's a little older. But he's a great asset to our team, and he's an amazing person, and he knows a lot about loans, right? Tell us a little bit about you, Chris.
Thank you, brother. Honored to be a part of the show. Honored to be a partner of your team. I've had positions in high places as a portfolio manager. I've opened 4 different call centers from start to finish. At my peak, I've managed maybe 140 employees and $18 billion. So I am young. I will embrace my youth, but I've been honored to have some amazing mentors and had some very high places. The reality is I got tired of making other people rich and decided it was time to open up my own shop and start my own racket. And here we are today as Vice President of Lending with Guaranteed Rate. And, now what I do in a very short scope is help people acquire the American dream of home ownership. I couldn't do it without my real estate partners. And between the two of us, our clients have a very good experience, generally a 30-day experience. And the purpose of today's show is to give you guys an idea and some color on why there are different loan programs, the strengths and weaknesses of both, and give you guys, a mindset to understand that home ownership is a lot closer than most people realize. To be frank, we have the blessing of helping many families buy homes, oftentimes with under $6,000 or $5,000, depending on the purchase price. So we're hoping that we can give some families some hope, some confidence, and help you guys obtain homeownership as well.
Definitely, you mentioned something very important that a lot of times people don't realize how easy it is to get a home, right?
That's right. Most people are a lot closer than they think. There's a lot of tools readily available that people don't realize are within arm's reach. If I had to put it bluntly, the most important thing to focus on to get to this point of homeownership is credit preparation. The thing about that is it only updates once a month. So if we consult with you, we meet with you, I would say 50% of my clients don't qualify day one. So if we do have to do some repair, you do it today. Most times it doesn't reflect till day 60 or 90 of our consultation. So big picture, guys, Credit Karma is free. Most bank applications offer at least one free credit score. The reality is the banks take the median score out of the 3, but the reason this is important is when it comes to the FHA loans, they are known historically as the first-time homebuyer program. They're not only branded to first-time homeowners, but the reason why they have that is because the down payment is strikingly low. It's only 3.5% down. Now, let's take a step back again to the credit piece. On FHA loans, the minimum FICO score per the FHA is 500 FICO. Now, although they will finance those individuals, the question is how many banks are willing to bank them, take that risk. Honestly, today is July of 2021. We're still rebounding from COVID. I don't want to say the banks are still scared, but they have their guards up. Most banks are lending 640 plus FICO. I'm honored to say we're still helping people at a 580 plus FICO. On the conventional side, we don't set the guidelines. The loan aggregators do. They require a 620 FICO. The reason being is these conventional loans, they offer a vast amount of products from investment homes. They do financing up to 4-unit homes, so literally an apartment complex, a small one. They do second homes, so if you've got a family that you visit out of state, obviously you can use that as a vacation home. And then, of course, primary homes. So to be very clear, you have conventional on the right side that will do 620 plus FICO lending. You have FHA on the left side, which will do 500 plus FICO lending. But the purpose of FHA is only primary loans. On conventional, you get a whole menu, which is, again, why they're different products for different uses. I do want to be clear that conventional does have a first-time homebuyer program for 3% down, but you generally need to have above a 7 to 720 FICO score to qualify. I've got a lot of experience writing loans. They do honor and offer it to everybody as a first-time homebuyer, but in my experience, we haven't gotten approval unless it's above a 700 FICO. So
okay,
that covers our bases.
Perfect. Let's take a step back. So, what is an FHA loan? What determines an FHA loan?
Sure. So there's different mechanics for different loans. FHA is the Federal Housing Administration. So by definition, they are a government product here to support the ability of housing, right? The government is not in the nature of helping investors. They're not in the nature of luxury homes. So by definition, they will only give you the money for primary housing. So again, with conventional having this luxury of menu of seconds, investments, apartments, that's off the table. Now, it's very important to understand that because they are different products in the same space, they have different mechanics. As an example, there's what's called county loan limits. We're calling you today from Arizona, Maricopa County, and with that statement being said, the loan limit here is $368,800. If you were to go to the conventional side, don't quote me on the finite dollar, but it's $548,000, I believe, $200 for the conventional side. Why? The FHA, again, is not in it for luxury. They're here to support general housing. And in their eyes, anything past that $368,800 marker, you're in the luxury home space. So they're different purposes for, the same concept, but they have different mechanics on the back end.
And from what I've heard, the Federal Housing Administration was there to help families obtain a house without putting a substantial amount down as a down payment. But conventional has also been very competitive now. So you can get a conventional loan with a 3% down. You can get a 3.5% down with an FHA loan. So
that's right. So the down payments, just to cover those topics, FHA is 3.5% down. That's regardless of it's your first time buying, your third time buying. That's just what their minimum down payment is. On the conventional side, if we were to do a first time home buyer program, again, you've got to have sharp credit. You can slide in the door with 3% down, and then you've got closing costs that follows. If at any point you're buying a second, it's your concurrent home, your second home, you're required to do a 5% down. So again, to be clear, it doesn't matter if you bought FHA your first time and now you're switching to conventional, or you bought conventional your first time and then you're doing it again. If you have a history of mortgage activity on your credit report, they will brand you with the 5% down.
Perfect. Okay, so good. So, and then seems like the FHA loan, from my understanding and working in this business, has more flexibility with the score, correct?
It does, but there's strengths and weaknesses to every program, and that's why it's very important to work with a seasoned banker. I'll give you an example. There's community property law. There's a few states that follow this. To be exact, it's Arizona, California, Idaho, Louisiana, New Mexico, Nevada, Texas, Washington, and Wisconsin. If you live in one of these states, you have to follow community property law. And what that means is you share everything with your significant other, your legal spouse. So that's the good, the bad, the lawsuits, the liabilities, the medical bills. For better or worse, we sign the contract, and that's how the law will fulfill it. It's the same with lending. So prime example, and it breaks my heart because this happens often, but you might have one person who in that relationship is doing well financially and they're supporting the family, and you got somebody else who maybe had some hardships or isn't doing too well, and they've got a flood of credits. We're seeing a 550 score, 540 score, 30,000 in collections. But hold on, my husband, my wife, they're doing good. We want to piggyback off them. Well, that might be so, but because we live in a community property state, I got to take the good with the bad. And although your husband qualifies, once I throw this 30,000 of blanket debt, we no longer qualify. Right. So in this example, I would basically say, guys, for this reason, we got to do the conventional loan because we got to basically blanket this debt sheet. And the reason for that is FHA, Federal Housing Administration, is a government product. They cover government laws, and that's just what it is. It's a government entity. If you do the conventional, they are privatized banks that are backed by a Wally operation of Fannie Mae, Freddie Mac. You've heard of these loan agencies, so you get a little bit more leniency. But again, it's important to understand the mechanics of each loan because they really do give you different benefits depending on what that client financial profile is. You really do have to be a chameleon and give the best shoe to fit that situation.
Got it. Okay. So now with conventional loans, you can buy a second home, you can buy an investment, and also another question, you can also buy like a fourplex, right? That's the max you can buy. So you can live in one unit, rent the other three, and purchase it as a regular home?
That's right. Fannie Mae and Freddie Mac will allow you to finance up to a 4-unit. Now, there are some stipulations to that. Generally, you are required to do some sort of a rental class to obtain this type of branding. Why? At that point, you're working in the capacity of a landlord. If it was a 2-unit, they'll let you slide, but anything past that, they generally will.
Got
The
it.
other important factor to that, guys, is you do also get the ability to use that streamline of income generally. Fannie Mae and Freddie Mac do have different requirements on this, but basically what it boils down to is if you're buying a home that has a history of recorded and documented income, you can use that in the capacity to qualify for the new purchase. So prime example, let's just say somebody's going to buy a 4-unit property. They've got a regular job. They maybe make $42,000 a year, and they alone would not qualify. But because the other 3 rental units are producing income, now they're overqualified. The bank is super happy to give them this approval. Pass it through, guys. We're good to go. So there are lots of perks and benefits, but it's the bigger picture of that. I'll let Juan speak more on the gain of equity, the benefit of others paying down the loan balance, but he's going to be much more well-versed to handle this type of question. So you want to talk on that topic, buddy?
Sure. And we got a question here. Let me go into this one real quick. It says, if we owe the IRS, does it affect both conventional and FHA? They're on a repayment plan.
So that's a great question because there are a lot of folks that are on payment plans. It's the IRS. Nobody wants to pay taxes, right? So
Right.
to cover that topic, it's not a straight yes or no. You have options. If you're on an existing payment plan, you generally need to make at least 2 payments with that payment plan that was given to you by the IRS. And then the third payment, as long as it's happening as you're closing your loan, the banks that honors the guidelines. They'll allow you to close. So again, if you have an existing payment plan, that's okay. You just need to make sure that you're handling that debt accordingly, and the banks will let you close. Now, if you've got a large balance, you're not on a payment plan, the banks will not let you close. Your only option in that specific example is to pay off the balance in full. So if you're buying a house, closing cost is 15 grand, you owe the IRS 5 grand, you're not on a payment plan. Unfortunately, these contracts on purchases only last 30 days on average. You're not going to have enough time to set up a payment plan. But what you can do is say, hey, I've got some extra money saved up for this example. I'm happy to pay the 5 grand at closing. The banks will say, okay, no harm, no foul. And what you need to understand, folks, is the IRS, they are a tough institution to work for. They don't bend over backwards for anyone. These nasty things of garnishing your paychecks, levying your bank accounts, coming after your child support checks, your Social Security. I mean, they will recoup their funds. And the scare with the banks is, hey, we gave you a loan, and that money that we were banking on is now no longer subject. And then we hear these things like foreclosure. It just becomes a nasty topic of debt. But the whole thing is, if you're going to borrow money from the government, FHA, they don't let you do it unless you pay the IRS. They're in cahoots. It's a branding of government. So that's the reason why we do that. But absolutely, you can buy a house. Don't shy. As long as you're responsible, you're on a payment plan, we're good. If you're not, no harm, no foul. Just make sure you got enough cash to cover your closing costs, down payment, as well as the IRS.
Got it. Another question here. It says, what's the most common misconception that people have during this market when applying for a home loan?
I think a lot of people in their mind believe that you have to have 700 plus FICO. They think they need to be at their job for, stability of 2+ years, 5 years. I've even had people think that, I have to put 20% down. No, I mean, the reality is, folks, practically every state out there offers some sort of a state-backed down payment assistance or a nonprofit down payment assistance. You'd be surprised. I would advise you guys to Google down payment assistance, and by nature, you'll see what's local to you and what's available to you. But I'd mentioned earlier that Juan and I, we make the American dream happen month after month with dozens of families monthly. And the key secret to that success is down payment assistance. So there's different levels, different parameters. There's different types. To give you a short breakdown on that, there's what's called the forgivable and the non-forgivable. As it mentions, after a certain time frame of holding this mortgage, that down payment that was gifted to you is fully forgiven. There's some states will say, hey, we'll give it to you, but when you sell a refi, don't forget to pay us your down payment that we gave you, right? So they're both good. They get you in the door, but obviously we want the free money, so we go for the forgivable down payment assistance. Now, I should note with the different levels, you generally can petition 3% help, 4% help, or 5% help. So the more help that you request, the higher the interest rate. And that's how the state or nonprofit can afford to give you the down payment, because over time, they're going to recoup some of those funds, if not all of them, by hiking up that interest rate. Now, it's seriously one of the best programs we have, if it's not the most popular. There's absolutely nothing wrong with it at all. It's the exact same loan agencies, but the difference is, as it sounds, the down payment is being gifted to you. So let's just take a step back and we'll digest this with an FHA loan. If we're going to buy a $300,000 house, 3.5% down is $10,500. If you're going to receive the 3% from the FHA, well, you're getting $9,000. So now my down payment, because it's been subsidized, is now $1,500. Holy smokes! My closing cost is only $4,000. I'm in the door for $5,500. You guys, I'm so happy. I bought a house for less than what I bought my car for. People don't realize this, but home ownership is so much closer within arm's reach than what they realize.
It's so close, and that's key, because I mean it's ignorance, and it's, I think the reason we're doing these videos is for that particular reason, because there's a lot of ignorance, misinformation, and my friend told me that this that, but they don't have the right information. So we want to provide you guys with that.
Don't take home ownership advice from somebody who doesn't own a home. First off,
exactly.
Go to the pros.
Don't ask me for how to look fit when I don't. I'm not. So,
hey,
but anyways,
you got the body of a working man, my friend.
What's that?
I said you got the body of a working man. That's what a real man looks like.
Definitely. So, and we're gonna break everything down, and we're gonna do more videos about every single topic. And if you guys have any topics you want to talk about, please let us know. There's another question that says, do they update the price based on the market? We've seen home prices rise, making those prices higher as well. Is that question based? I believe it's based on the limit for the FHA, and right?
So there's twofold to that. So every year the FHA takes a look at the median annual sales price, and for every county it's different based off the market activity. Obviously, every state has some municipalities, state capitals, and usually the concentration of those homes creates more frequency in transactions, so the prices drive up. Versus if you live in a very rural area, you're going to have less transactions. Why? The population is less. That's just the natural mechanics of real estate market. But to answer your question, every year, the FHA, as well as the Fannie Mae, Freddie Mac, the conventional agencies, they take a look at the median sales price and they do adjust. Why? The cost of living goes up every year, folks. That's just the mechanics of life. So again, it does rise. But to answer your question regarding the real estate market, we're seeing, and I'm sure we all hear this word on the news, unprecedented market activity, right? So what that means is, with rates being as low as they are, people can now afford to buy bigger and buy when they couldn't 3 years ago. It's been a spur of business. The average loans that we're giving out range from the high side of 3.5 as low as 2.875 on purchase. So they're very low, very obtainable. And to be frank, if we had that same family try and buy 3 years ago, instead of financing a $300,000 home, it would have been only a $200,000. So the interest rate makes a huge difference in your buying power. So that's first off. We got all these people that can finance that couldn't before. The second aspect of that, COVID. We got all these families being forced to work from home, kids doing school from home, and people are just overcrowded in their apartments, overcrowded in their 2-bedroom townhomes, and it's caused this spark in, hey, financially this looks like it makes sense. We're tired of being crowded, and what it's caused is quite frank, somewhat of a bidding activity where it's 30 people going after one home, and everyone's saying, I'll raise it 500. Oh, I'll raise it 1,000. And then you get some crazy guy who says 10,000 and I'll waive the appraisal, right? So, what we're seeing, guys, is it's a shortage of supply and demand with low interest rates, and people are just tired of being in their homes through COVID. But, things are starting to balance out here, and just like in any, economic impact, there's always a little bit of, scarcity, inflation, however you want to chop it up, but things are starting to calm down. That's for sure.
Yeah, we see. I call it a window of opportunity. And what happened? We just went through the market report with the Crawford report with Tina Tamber. She's the authority here in the Phoenix metro area for numbers.
Sure.
And basically, it's not that the demand is diminishing; it's that the inventory is increasing. So if you're out there wondering when is the best time to buy, I say now. And it's always been now, because again, I always talk about the analogy of the year. When is the best time or the tree? When is the best time to plant a tree is 20 years ago. And the next best time is today, because if you keep waiting, that tree's not going to grow. So you got to start now. So if you guys have any questions that you want to ask, please send us a message through Facebook. We would love to provide you guys with information that you want to know. We do this all day long, every single day. So this is like, natural to us. We can We can go on and on about stuff that we do. And some terms that we speak. If you guys don't understand them, please ask a question. How to help you guys out and understand this better. But like Chris was saying, if you want advice from a professional, go to that professional.
Please,
Don't go ask for accounting help to your priest. Go to your accountant. Don't take your doctor to court. You're gonna end up in jails, right? So when you need real estate advice, please call us. Reach out to us. We're here to help.
Yes, sir. Thank you, guys. And I couldn't toot my horn more to Juan. It's not every day that these not only experienced but successful realtors, successful bankers take time to give advice. And it's unfortunate because most bankers, most realtors say, hey, you're not pre-qualified, see you later. Hey,
Yep.
You don't have a 700 FICO score, I'm not here to work for you, figure it out, right? And the reality is we have such a huge sphere of influence. We have such a plethora of clients because we do serve the underserved. We do educate. And as mentioned, half my clients don't qualify day one, but we put them on a path to purchase. We tell them what we need to do. We're going to save some of this content for later episodes, but there's definitely some secret sauce to the credit guys, and we're happy to get you there. So use us as resources. We're happy to do the pre bono work and serve the underserved out there for free.
And I was on the other side, and I mentioned this often too. Nobody wanted to help me when I was going to buy my first house. This was back in 2004, which was a similar market than what we have today. It was crazy. It was busy. So I had low income. I had terrible credit. I was job hopping, and I was a nightmare for the lender, right? So nobody wanted to touch me. So I went for a year, knocking on doors. Nobody wanted to help me. This guy took the time, helped me out. About a year later, after I left Chase, he asked me if I wanted to work with him doing loans. And I said, you know what? I would love to do what nobody wanted to do with me and take the time to invest it in people that really want to purchase a home and have, no idea where to start. We want to be that resource for you guys. So if you've been underserved and you have any questions, again, reach out to us. You don't have to buy or sell a home with us. You don't have to get a mortgage loan with us. We just want to help you out, and we mean it from the bottom of our heart. Just
have a plan. Just have a plan. We all need somewhere to live. And if you're dedicated to renters, maybe you're in the military, you don't know where you're going to live, that's fine. But there's nothing wrong with having financial well-being. And the reality is, guys, they don't teach you this stuff in school. I don't know a single college class that breaks down credit. And ironically, it's one of the most important things in life. It affects your house, your cars, your finances. I mean, everything, right? So again, we're here to help you and educate you guys. And this is real working concept. This isn't something out of a textbook. So
algebra, calculus, and all that other stuff is not going to help me in life?
Well, the details matter and everything. They do. But big picture, we're here to put you on a path.
This is important stuff.
Yeah.
And you said it. I mean, this is real important, life-changing stuff that is going to help you. First of all, get into a home and then start building wealth with it. Edgar's asking if you have any experience with VA loans.
Absolutely. It's probably the pound for pound most powerful loan. The VA is it's a weird concept because they do jumbo loans, which is for sure the $1 million luxury homes. And we even do the smaller, side of manufactured homes. We do the down payment assistance with them. They will lend as low as 500 FICO. And for whatever reason, banks are more happy to do lower FICO lending with them. I mean, they even have crazy stuff like, no document refinance. As long as you pay on time, they'll refinance you. Just show me your last mortgage statement, proof your house is insured. So we do them well. And, just to give you a little color on those, if you're a disabled veteran, the VA will waive their fees for you on that purchase. My camp, Guaranteed Rate, specifically my branch, we will waive all of our lender fees for veterans. And if you do the down payment assistance program, I kid you not, I will cut you a check at closing with this program. I do it time after time, and people are dumbfounded that they put $1,000 down and I'm cutting you an $1,800 check. So they absolutely do exist, guys. It is the most powerful loan program. If you're a veteran, please use your benefits because you earned it, and it's just pound for pound better.
Yep, we're certified military specialists as well. So anything you guys need, you guys sign a blank check for us. We're here to help. Any questions you may have. And Claudia's asking other questions. Could you go over down payment assistance programs, often referred to as first-time homebuyer?
Sure. So we went over that a little bit in detail. Again, there's 3 different levels: the 3%, the 4%, and the 5%. I do need to be upfront that there is a minimum FICO requirement, and it is not set by us. It is the source of that down payment. In most cases, it is a higher minimum FICO. So as an example, here we use AZIDA Home Plus. With that requirement, you do need to be approved as a lender as well as a loan officer or loan agent. And to get into the mechanics of it, although FHA will do a loan as low as 500, their requirement is 640 plus FICO. Why? In the eyes of the nonprofit or the bond program from the state, they feel like, hey, you don't have much skin in the game, right? Because you're not using your own money. We want to make sure that you're financially stable with credit. So that's key one. Key two to it, there's always a hook on this money, right? We talked about forgivable versus non-forgivable a few minutes ago. The stipulation with the forgivable money, you generally have to be in the house for a certain time frame. In our program with AZIDA, it's 36 months. If you do end up selling or refinancing within 36 months, that's absolutely okay. You're not chained to that house, but you do have to give that money back. So I'll give you an example. Let's just say your down payment came to the source of $9,000. After year one, if you were to sell, you got to give them $6,000 back, right? Because every year $3,000 falls off. If after 2 years, you got to give them $3,000 back. After 3 years of home ownership, it's fully forgiven, whatever you want to do, right? So again, it's not to say that it's a bad program by any means. It's free money, but they're not in the business of giving it to investors. They do want to help out the local community. Why? You pay taxes, you participate in jobs, your kids go to school, the economy goes round. So as long as you're okay with the stipulation of, hey, I'm really going to live here for 3 years, and if things happen, I got to sell, I got to move, no harm, no foul, I just have to cut a small check of my earning. Cool. It's the best thing and the closest thing to free money. I would definitely advise it. But that's it, guys. Those are the restrictions on it. Is you just can't make, well, actually, let me rewind. You also can't make too much money. The down payment assistance is for people who need it. So here in Maricopa County, the cap for FHA is $118,000 and some change. On the conventional
That's a lot of money,
side,
right, to be making if you're going to get even free money at that point.
That's what I'm saying, and I wish you would tell that to my partners on the conventional side, because as a family on the conventional, I believe you can't make more than $62,400. Now, every year this does change as they digest the median family income, the median sales price, but it's definitely not a fair playground. So again, this is why we use FHA versus conventional. It's honestly, guys, what I do for a living is puzzles. I solve puzzles, conditions. Hey, you meet this, but you don't meet this, right? So it's very important that you understand the mechanics of these loans, because it will make or break your experience.
And the other thing is the beauty of working with a professional is that you're going to give them options. And at the end of the day, these are the options that, that I consider would fit your needs. And you make that decision. Sometimes people say, well, what are you going to give me? Well, we'll give you the options for you to make that decision. We would recommend this option, which is more affordable. At the end of in the long run, is going to cost you less. However, you have options to choose what best fits your needs. One last question. How soon can a recent college graduate apply for a home loan?
Great question. So it's not a yes or no answer. There's a little bit of moving pieces on that. Let's just take income and break that down. You have what's called variable income, and then you have fixed income. So generally, the variable means it could change month to month, right? Keyword commission. Most people think of differences in commission. If you are going to work a commission job, you generally need to have 2 years of activity. That doesn't matter if you're an employee and the majority of your income is commission, right? It doesn't matter if you're 1099, because your earnings change month after month. The bank says, well, hold on, you had a good month this month, but what's going to happen next month, right? So prove to us that you're stable. So the stability calculator is 24 months. You literally need 2 years of tax returns. I want to repeat that. It's not like, hey, I've been at this job for 2 years. That's fine. You may have had a year and a half, but if you don't have the 2 years of tax returns, we don't have financing. So once you have 2 years at that employment, 2 years of tax returns, without question, you will satisfy the guidelines. We do a 24-month average of your income or your Schedule C 1099, and that's how we qualify you. Now, let me flip this on the other side, fixed income. You have hourly pay and you have a salary agreement. If you're a salary wage earner and your pay for simple numbers is $120,000 per year, rain or shine, sick or in person, you're going to get paid your $10,000 per month. So the bank will use your offer letter as the cover sheet of your income and say, hey, you're good, rain or shine, we know you're good for the 10 grand. We'll qualify you based off this. If you're an hourly employee, and in Arizona, it's 35 plus more hours per week average, we will use your hourly rate times the amount of hourly earnings that you're awarded. So in that parameter, you obviously got to consistently work. If you went sick for 2 months out of the year and then showed up the other 9 months, or 10 months, we're not going to give you the full 12 months times 40. So it's important that you keep that there. Now let's associate that to the college question. The beautiful part is, again, with homeownership, we want people that are educated. We want people that are savvy, that have career paths. And the banks aren't dumb. They know that people that have education generally follow career paths. So we want that clientele. So what the details are on that is, as long as the job field that you go into is associated to your schooling in a university, we will grant that. So I'll give you a prime example. What I normally have is somebody who's a medical student who lands their first nursing job. 6 months into it, they're making some real money. They're able to pay off their loans, or their loans are going to be forgiven, or they're deferred, and we can get you in the door that way. So let's just say you graduated 6 months ago, January. Hey, Chris, I'm ready to buy a house. I don't have 2 years of history. Well, hold on a minute. Technically, your school was your profession. Whether you're hourly or your salary, we'll give it to you. So to answer your question, as long as you have a history of schooling towards that, and your gap from work and schooling is not outrageous, the banks will grant you your income. We count your education as work history. Good question.
Awesome, guys. Well, thank you so much, Chris, for joining us.
Of course.
Thank you for the questions.
I look forward to the next one.
Definitely. We're going to break everything down and go deeper in every subject. So, and again, send us your questions. Thanks again.
All right. Have a good day, everyone.
Bye.